Good evening, everyone. Time for another silver update. Apologize beforehand if I'm long-winded on this one. There's a lot to cover tonight due to the events in the markets today. We are looking at the chart of the US dollar Japanese yen. Now, we started the morning off with an intervention in the Japanese yen. And you can see the volume that came in for this intervention is not really that significant. I think this was unilateral intervention by the Bank of Japan, and you can see this was the Fukushima intervention. This was actually G8 intervention, coordinated intervention. So you can see the run that we had with that intervention. We went from down here at about 76.7 all the way up to about 80, almost a 10-point run in the dollar yen, which is absolutely astounding. So that was a freight train. You had to get out of the way. As I pointed out at the time, that you, as Jimmy Rogers has said, you always want to wait for intervention, wait for it to peter out, and then take the other side and go the other way. So you can see it was a wonderful trade to short that intervention. And now we've come up and we've ticked against the trend line, so we'll see where we go. The other intervention story that we had was the Swiss franc, and you can see that on the long-term chart it's not very successful. If we go to the close in and actually view the intervention in real time, there was a story covering it on Zero Hedge, and the story was posted around this point here where they mentioned that the intervention had failed. The intervention actually hasn't failed. It's still holding, but the intervention is very weak. So you can see that the Swiss central bank intervened right here on this volume, and market forces sold it off back to the intervention point. Then a rally occurred, probably more Swiss bank intervention. Then we had a tremendous amount of selling, possibly, who knows, hedge funds, sovereign wealth funds. We don't know who's doing this selling, but the Swiss franc is extremely strong, and money was rushing to what was viewed as a safe haven. Now, that's what I wanted to look at with some of the other issues I wanted to talk about. First of all, though, I want to jump over to a chart of the Dow. I don't pull up a lot of charts on the stock market because I haven't been in the stock market for years, literally. I don't recommend the stock market. Obviously, it's a paper market. I don't even recommend mining shares because it's, again, paper. I only recommend physical silver and physical gold. So, but it's a very interesting chart because as soon as we had the announcement of the deal on the national debt, we get this, I won't say it's a catastrophic collapse, but it's a fairly dramatic collapse, and it's fairly dramatic because it obviously penetrates this well-tested trend line that goes all the way back to March of 2009, which was the bottom at about 6,600 on the Dow. So the issue I really wanted to talk about tonight is the anatomy of a deflation scare and how that works. If we go out on the long term, you can see that we already weathered the tremendous deflation scare that was the 2008 crash, and most of you were around for that or were active in the markets. You remember we had a pretty much straight line crash from midsummer in 2008 from about 14,000 plus all the way down to 6,000. Bigger than a 50% haircut. A huge move. And we seem to be shaping up to be doing something similar right now. But I wanted to try to look at the reasons why these types of things occur. And I'm going to have to start with bonds. because that's one of the things that's very confusing for people. So I've pulled up the just general Wikipedia article on bonds, and you can read that. It's fairly involved, but the two things I wanted to really seize upon are the major risks that you have when you invest in bonds. Now, bonds are by definition a note that represents a loan from one party to another. So it's a loan of money that is to be repaid in the future based upon a time frame and a interest rate, and there's a lot of variables, but to understand the basics, it's just simply one person loaning money to another person at a certain interest rate and a certain time frame. So that's what you have to keep in mind to understand how bonds work. Now, the two primary risks I wanted to look at, because those are the major ones in play with what we saw happen today. You have two major risks. The first risk is the credit risk, and that is the risk that the borrower does not make payments as promised. That was the risk that we saw with the discussion of the default, which obviously was a phony issue because there was no issue of default. It was just used by politicians to ramrod through another massive increase in the national debt. But there was never a risk of default because obviously the Treasury brings in almost $2 trillion, more than $2 trillion in taxes, and the interest rate was only a 300, 400, maybe some have said 500 billion, but still a fraction, not a tiny fraction, but still a fraction of the amount of monies received by the government. So default risk was never an issue with the debt ceiling debate, but that is a risk for any bond. The first risk that you have with any bond is the danger that the person who borrowed the money will default and not pay the money back. So that default risk goes into the interest rate calculation of a bond. The other primary risk that you have, and there's a lot of them listed here, but they're all interrelated and they kind of overlap. The other main risk is the inflation risk. And that page has been deleted. That's fantastic. In December of 2008. So, even though the page has been deleted, I will explain inflation risk to you. If I borrow $100,000 from you and we set an interest rate of 5%, then for 10 years, then I'm going to pay you back a portion of the principal plus that interest rate on regular payments, whatever they're set at, and you're going to collect that money. Now, the risk that you're taking besides the default risk is this inflation risk, which Wikipedia has decided to delete. But in short, what that risk is that if the government that controls the currency that the promise of the bond was made based upon begins to inflate the supply of that currency, then there is a risk that the person who owes you the money will pay you back with confetti dollars. They'll pay you back with dollars that aren't nearly worth the same thing as the dollars that you loaned. So those are the two primary risks that you see when you loan money to someone else, when you create a bond. You take the risk that they're not going to make the payments, they're going to default and leave you with a loss because you loaned a large amount of money and you only got a certain amount back. The point where they stop making payments, that's all you got. And the other risk is that the money that you're paid back over that period of time has devalued to such an extent that it wasn't worth the money that you loaned plus the interest that you gained. So you set your interest rate too low based upon either one of those risks. So those are the two risks that go into determining the price of a bond. And I wanted to take you over to a chart that shows you, that gives you an idea of how those things interact. And I have to introduce all these ideas before I get into the action of what happened today. So let's jump over and look at a chart of the interest rate on the 10-year note graphed against the Dow Jones Industrial. The candlestick line that you're looking at here is the interest rate on the 10-year note. The line graph is the Dow. So you can see, now it's not granular enough to see where we are for the year, but you can see it's getting close to zero for the year. This is actually, we're looking at a 5-year chart, so it's actually calculating it back to 2006. So, but for our purposes, that serves us well. So you can see the crash of 2008 that occurred, and a couple of things jump out at you. First of all, the crash in the interest rates. Remember, this is a graph of interest rates, not a graph of bond prices. Those are inverse to each other. So as bond prices rise, interest rates fall. So if I did the bond price crossed against the Dow, you'd see one going up and one going down. But when I put the interest rates over the Dow, they tend to move in the same direction. So you can see that as interest rates fell, and if you go over and highlight these, you can see up in this area, up in here, is the actual rate. Where it says TNX 4.232, that's the rate on the 10-year note. So you can see when we go all the way down here, the 10-year note actually reached, if you look up here while I'm moving over here, the 10-year note reached almost a flat 2% yield. And when the Dow was at about its low of roughly, where are we at, 6626? I think that was about the low, maybe a little lower, but that's what shows on this chart. When we were at about 6626 on the Dow, we were at 2.8% yield on the 10-year note. Now, when we look at today, you can see we had a tremendous collapse in the 10-year note, and we actually are at 2.458%, lower than we were around the lows, while the Dow is at 11,383. So if this indicator is accurate, that is a scary indication of where the Dow is going to go. And we don't know that, but it seems to be in the cards. Now, the question you have to ask yourself is, why would the interest rate on a 10-year loan to the U.S. government be only 2%, and back in 2009, and today 2.5% roughly, let's say 2.5%. Why would a loan to the United States government only for 10 years only yield 2.5%? So that's the point where we want to jump in and try to examine the charts and the commodities so we can understand what a deflation scare is and how it works. So if you remember, I was covering the price changes in gold and silver as this debt drama was unfolding. And you can see, I'm going to pull up gold first. You can see that we were actually in a very healthy breakout in gold, which is understandable. And actually this morning, when we started to see the intervention by the other foreign banks, and you have to remember what that is, why you see that type of intervention. If you remember, we passed a debt bill that added $2 trillion to our debt. That put the dollar under tremendous pressure. Now, for reasons that are too deep to go into here, that impact was not seen in the euro chart, but the impact was seen primarily in the Swiss franc and the Japanese yen. The yen probably because of more carry trade unwinding going on, and the franc probably just because it's perceived as a strong non-euro currency. So money was fleeing to Switzerland to get away from the weakness that would come about in the dollar by printing up another $2 to $3 trillion, and the profligate spending of the United States government, and the obvious telegraphed intention that the inflation risk was going to be the way out. So money was fleeing the dollar. Now, what do you do? What do you do when you have a situation where investors are fleeing from your currency? Now, we need to go back and examine this cross chart of the Dow and the 10-year note, because some of this started when we had a blowout with the yields in the European bonds. I think the bonds were Italian and possibly Spanish bonds, but we had some no-bid situations going on and interest rates skyrocketing, and we were seeing 6, 7, 8%. So high rates, the risk was high, so the rates were rising. But we come back here and we see that the rate is falling on the 10-year note. Why is that? Well, if you remember, I pointed out when this debt deal was happening, I pointed out that once they got the okay to borrow another $2 to $3 trillion, they were given the ability to borrow it, but that doesn't mean that somebody was going to lend it to them. It simply meant that they had the authority to try to borrow it. So that still left in the future large auctions that would have to occur, where the Fed, well, not the Fed, I'm sorry, the Treasury would have to go out and auction off an enormous number, tens of even hundreds of billions of dollars of bonds. And who's going to buy those bonds? We know the Chinese are backing away. We know that the Saudis are backing away. We know that Europeans are backing away. So, as I pointed out for the last couple of days, we're going to have a QE3 situation, because it's going to have to be the Fed that buys these bonds. Okay, so that's key. Keep that in mind. There aren't enough buyers for our bonds, and that should be reflected in the interest rate, but it's not. The interest rate is dropping. Why would the interest rate drop when there aren't enough buyers for our bonds? Because we're monetizing our own debt. Because the Federal Reserve is buying the bonds issued by the Treasury to keep the price high, to keep the interest rate low. Because if you remember the statistics on the national debt, if we looked at our 14, which is now going to be $16 trillion, and did a interest rate of 10% on that, we're talking $1.6 trillion in interest rate payments. And we only take in $2.2 trillion. So that's above 70% of the payments going only to interest. That leaves nothing, virtually nothing, for anything else. Defense, Social Security, Medicare, all that stuff has to be cut to the bone. I've proposed 50% across the board cuts, but that situation would require 75% across the board cuts. So obviously the powers that be in the United States cannot afford for interest rates to rise to the same level that they're rising in the debt-laden European nations, because we'd be instantly bankrupted. So let me get to the main point. You have to have a deflation scare to scare the money into these bonds. Either that, or you have to have a deflation scare to create the cover for another QE3. The second one actually is my first choice, because I think that the Fed has already decided they're going to do QE3. They just need cover to do it. And obviously, there could not be any greater cover than a complete collapse in the stock market. Because the stock market contains everyone's retirement. It contains an enormous amount of investments by various state and local governments for their pension funds. So a catastrophic collapse in the stock market, something like we saw back in 2008, if you remember, when we started getting to the point where they were carrying out Lehman and Fannie and AIG and all these companies are carrying them out. And you had threats of martial law in the Congress unless they pass the TARP. That's the point they need to get us to bring in another QE. To give them the ability to buy the bonds that no one wants. To give them an excuse to monetize the debt. So I don't think it's a coincidence that as soon as they passed the debt ceiling increase, we get an enormous tanking in the financial markets as potential cover for a needed QE3, as we've seen the financial reports about jobs, PMI, industrial production, all of the economic reports about the health of the economy are falling at a rapid rate. They're letting loose all the bad news at the same time. The stock market is cratering at the same time. So it appears to be a window they're creating to have a deflation scare so they can scare up enough money into bonds, or scare up enough people into QE3 to get this new debt that they've issued covered. Now, the last thing I wanted to talk about is how this impacts gold and silver. Now, when you hold physical gold and silver, you are not going to be scared out. Well, hopefully, you're not going to be scared out of your position by some type of deflation scare. And the reason why would be if you understand that gold and silver are both a inflation and deflation hedge, then you won't be taken away from your position. So we need to go back to the two risks that we were talking about for bonds. The first risk being the inflation risk. With the inflation risk, the risk that the money you've loaned, you're going to be paid back money that's worth less than the money you loaned. And that makes your bonds worth less than you thought they were worth, and potentially even worthless if there's such a dramatic inflation event that the currency's blown out and you're paid back with toilet paper. That's the inflation risk. Now, gold and silver, physical gold and physical silver, do not have that risk because they're not a debt obligation. Therefore, there's nothing to be paid back. Therefore, as the currency is depreciated, they rise in price, so they protect you from inflation, and they protect you from an inflation risk. On the other hand, the credit risk, which is the default risk, this is a risk that someone who owes you money is going to default and not pay you what they owe you. Again, gold and silver, physical gold and silver, are not subject to default risk. As long as you hold them in your hand, no one owes you anything, and they don't lose money because someone else defaults. So why do we see a drop in gold and silver? If you notice gold, we did not get the drop that we saw in silver. So if we go to silver, you can see we got a fairly dramatic drop, much higher percentage-wise than we saw in gold. Why? Well, you've got to understand how a deflation scare works. A deflation scare is when people are scared away from paper investments into cash. What is cash? Well, it's not bank deposits, because that market is not large enough to take the amount of money that needs to come in a deflation scare. So you're really talking about treasuries. You're talking about 3-month, 6-month, 9-month, 1 year, 2-year, 5-year, 10-year notes. You're talking about money fleeing into these investments, and that's what you see when you look at this chart with this drop. So money is fleeing away from a default risk of paper into government paper, because it perceives that the government paper, bonds, are safer than company paper, stocks. And the ultimate safe paper is going to be treasury bills, the shortest term yield, and even safer than that is bank paper, because it's backed by the FDIC. But how are you going to move $50 billion into bank paper, which is guaranteed to $250,000 per account? You can't. So your only option is to flee into treasuries and the dollar. And that's why you see this strength in the dollar. Now, gold, on the other hand, and silver, on the other hand, only provide a deflation protection to the extent that the gold and the silver that you're fleeing to are physical. If you are fleeing to paper gold, and this price here, even though it's stronger than the silver price, this price that you're looking at, this is gold COMEX spot. This is paper gold. So when there's a deflation scare, a chance of massive default, if you run to this asset, let's say you buy a ton of gold futures contracts, or you buy a ton of GLD, or you buy a ton of this, it's still paper. There's no way that the physical market can take the type of panic that's scared in a deflation scare, because there isn't the volume available. So it's not unusual to see gold sell off, paper gold sell off. These people are selling paper gold and raising paper cash to put it into treasuries. Now, the last question of the day, because it's gone too long, obviously, is why did gold only correct this much, and you can see we're rallying back? And why did silver correct this much? Well, we want to look at the volume to start with. So let's clear off our indicators and take a look at the silver volume. Now you can see, and a lot of people have disputed these figures, I think they're accurate, but when we look at the volume on silver today, it was a very dramatic spike, much larger than regular days. So if we pull back farther, we can see how dramatic the volume spike is in silver. We had a big 30,000 spike right here that preceded this long rise. But today we had multiple tens of thousands spikes coming in and selling silver. So the question you have to ask yourself is, who had to raise cash by selling off their paper silver investments, as opposed to who had to raise cash by selling off their gold paper investments? Well, obviously, the silver market is a tiny market. So, is this people raising cash? I don't think so. So we're going to have to look at the open interest figures that we pull from yesterday and today and the next day and compare and see. My guess is when we look at these figures, we'll find that these were new short positions taken on by the manipulators to coincide with the crash that they wanted to cause in the markets to scare money into short-term and any treasuries so that they could either create cover for the Fed to bring in QE3, or they could just scare the money into those treasuries that they need to sell to cover this $2 to $3 trillion of new money that they printed, which caused the Bank of Japan and the Bank of Switzerland to print money like there's no tomorrow. So we'll have to wait and see if that's the case, but hopefully that explains to you how a deflation scare works and why they need to use that to chase money into the bonds of their debt. And we'll talk to you next time.